Assalamualaikum warahmatullah. Everyone, welcome back to our program here. I was earlier talking about the deposit-taking Islamic bank, and you know very well that the Islamic bank have adopted the highly leveraged conventional banking system. So that has been the case where our early founding father has established Islamic banking businesses where funding is obtained from deposit fund. The funds that is used to make loan does not come from banking capital, but it is coming from the funds provided by deposits. And as we have discussed earlier, that once the funds are labeled as deposits, then they are basically loan provided by the depositors to the bank. And therefore the bank is now the borrowing party who pays interest to the depositors in return for full capital protection and interest payment. And for that matter, the depositor will enjoy some kind of deposit appreciation over the tenure of the deposit. So the adoption of the conventional banking system that is highly leveraged is a problem actually to Islamic banking, because the Islamic bank is expected to use al-bay' or sale instead of loan in driving the Islamic banking business. But because that the Islamic bank have adopted the conventional banking model, so there are quite a number of complications regarding the use of al-bay' within a highly leveraged banking business. Now, what does it mean by leveraging? Leverage means to borrow funds such that the profit are expected to be greater than the interest payable. So, for example, the bank borrow at 2% from the depositor and charges borrower at a loan rate of 7%, which is higher than the deposit rate of 2%. And with bank shareholder obtaining 15% ROE. So we can see that by leveraging, then the bank will expect to make more than the cost of deposit. What more to the equity capital that the bank has invested in. So because of this highly leveraged system, whereby banks do not use their money to make loan, but to use other people's money, banking regulators require banks to hold adequate capital to support risk in loans. So for example, we start from V33 leverage ratio of 3. It means that for every $1 loan, the bank holds only 3 cents of capital. So what does this mean actually? So it means that if the bank is able to mobilize cheap deposit or zero cost deposit like current account and uses the deposit to buy government security that pays like 2%, then the bank can make 2% return without taking any risk, because this Basel III leverage ratio of 3% is a ratio that require the bank to take no risk at all. However, in any ordinary circumstances, when the bank make loan to businesses and individuals, they are bound to be a default, and therefore under that risk-taking event, then Basel III require bank to hold a minimum capital of 10.5%. So meaning that for every $1 of loan, the bank must hold minimum 10.5 cents to cover losses, right? So in a sense that if the bank holds 100 million worth of loan, then or if the bank holds $1 of loan, if the default is 5 cents, then the bank have enough capital to cover the loss of 5 cents. However, if the default is 20 cents from the $1 loan, then that minimum of 10.5% is not enough to cover the losses. So under a big default in loan, this can easily wipe out the banking capital. So that is why, when we are looking at a highly leveraged banking system, it is adequate model to source funding from borrowed fund. But the idea here is to ensure that this borrowed money is protected from losses, because this highly leveraged system can produce moral hazard that cause bank to be responsible or to be aggressive in making loan, because the skin in the game is so low, and therefore some kind of control must be put into order, and that will be government banking regulation. Okay, so we will continue further about this issue. I will see you again. Thank you very much. Don't forget to share, comment, and subscribe. Assalamualaikum.